In the autumn of 1998, the Federal Reserve Bank of New York convened an emergency meeting with the chief executives of the largest banks on Wall Street. The purpose of the meeting was not to discuss a bank that had failed or a market crash that had already occurred. It was to prevent both of these things from happening by orchestrating a bailout of a single hedge fund that most of the American public had never heard of. The fund was called Long-Term Capital Management. It had been founded 4 years earlier by John Meriwether, a legendarily successful former bond trader at Salomon Brothers, and staffed with a roster of talent that included 2 Nobel Prize-winning economists, Myron Scholes and Robert Merton. Men whose academic work on options pricing had provided some of the theoretical foundations for the entire field of quantitative finance. The fund's investment strategy was built on mathematical models of extraordinary sophistication, applied with a rigor that its principles believed had effectively eliminated the kind of risk that destroyed less disciplined traders. By September of 1998, this fund, staffed by some of the most credentialed and theoretically sophisticated minds in finance, was on the verge of collapse, and its failure threatened to take much of the global financial system down with it. Long-term capital management's investment strategy centered on what is called relative value or convergence arbitrage, identifying pairs of securities whose prices, according to the fund's models, should converge toward each other over time, and constructing positions that would profit from that convergence regardless of the broader direction of financial markets. A typical LTCM trade might involve government bonds of very similar characteristics, say, 2 U.S. Treasury bonds with nearly identical maturities that were trading at a small price discrepancy due to temporary supply and demand imbalances rather than any fundamental difference in their risk or value. LTCM's models would identify this discrepancy, and the fund would buy the relatively cheap bond while simultaneously selling short the relatively expensive one, capturing the spread as the prices converge back toward their theoretically justified relationship. The profit margins on these individual trades were extremely small, fractions of a percentage point. To generate the kind of returns that justified the fund's fee structure and attracted its enormous capital base, LTCM applied leverage on a scale that was, even by the standards of 1990s Wall Street, extraordinary. By the time of its collapse, LTCM's capital base, the money actually invested by its partners and outside investors, was approximately $4.7 billion. The fund's total balance sheet exposure, including the positions it had taken using borrowed money, was estimated at approximately $1.25 trillion in notional value across its derivative positions. This represented leverage of well over 200 to 1. Meaning that for every dollar of the fund's actual capital, it controlled positions worth more than $200, financed almost entirely through borrowing from the same major banks that would later participate in its bailout. The fund's models, built using sophisticated statistical techniques and historical data on the relationships between different financial instruments, assumed that the historical correlations and volatility patterns observed in financial markets would continue to hold, with deviations that, while not impossible, were treated as extremely improbable based on historical frequency. This assumption proved catastrophically wrong in the summer of 1998 when the Russian government defaulted on its sovereign debt in August. The Russian default triggered a cascading flight to safety across global financial markets that did not follow the historical patterns LTCM's models had been built upon. Investors worldwide, suddenly fearful of risk in emerging markets and uncertain about the broader stability of the global financial system, rushed to sell anything perceived as risky and buy the safest available assets, overwhelmingly U.S. Treasury securities. This flight to safety widened, rather than narrowed, exactly the kinds of price discrepancies that LTCM's positions were betting would converge. The relatively risky, less liquid securities the fund held became cheaper as panicked investors dumped them. The safe, liquid Treasury securities the fund had sold short became more expensive as investors rushed to buy them. Every major category of LTCM's positions moved against the fund simultaneously, a correlation in losses that the fund's risk models had assigned an extraordinarily low probability of occurring, because historical data did not contain a comparable precedent for this specific combination of simultaneous market dislocations. The fund's losses accelerated through August and September of 1998 at a pace that destroyed its capital base with terrifying speed. The fund lost approximately $4.6 billion of its $4.7 billion in capital in a matter of weeks, a near total wipeout of the fund's equity, while its enormous derivative positions remained outstanding and increasingly difficult to unwind without triggering further market disruption. The reason the Federal Reserve intervened was not sentimental attachment to LTCM or its partners. It was the assessment shared across the senior leadership of the Federal Reserve Bank of New York and the major banks that had lent money to the fund, then uncontrolled collapse of LTCM's position, a disorderly liquidation of $1.25 trillion in notional derivative exposure into already stressed markets, risk triggering a systemic crisis that could cascade through the entire global financial system. The banks that had lent to LTCM and that held derivative contracts directly with the fund included most of the largest financial institutions in the world: Goldman Sachs, Merrill Lynch, J.P. Morgan, Salomon Smith Barney, and others. If LTCM defaulted on these obligations in a disorderly fashion, each of these institutions would face significant losses simultaneously, and the interconnections between them, counterparty exposures running in multiple directions across the entire banking system, created the risk that losses at one institution could trigger losses at others through contagion in a manner reminiscent of what would later occur at much larger scale in the 2008 financial crisis. The Federal Reserve, under the leadership of Chairman Alan Greenspan, organized a meeting of the major creditor banks and brokered, without committing direct public funds, a private sector recapitalization of LTCM. 14 banks agreed to inject approximately $3.6 billion into the fund in exchange for ownership of approximately 90% of its equity, effectively taking over the fund from its original partners in order to manage an orderly unwinding of its positions rather than allowing a chaotic, value-destroying collapse. This arrangement allowed LTCM's enormous position book to be liquidated gradually over the following months, in a manner that avoided the disorderly fire sale dynamics that would have amplified losses across the financial system. The fund was effectively wound down by early 2000, with its creditor banks recovering most, though not all, of their investment. The long-term capital management episode generated a body of analysis and reflection that has shaped financial risk management theory and regulatory thinking in the decades since, even as many of its specific lessons were arguably underapplied in the lead-up to the much larger financial crisis of 2008. The central lesson concerns the limitations of quantitative risk models that rely on historical data to estimate the probability of extreme events. LTCM's models have been built by economists of genuine brilliance, using techniques that were, in a narrow technical sense, sound. The flaw was not in the mathematics, but in the underlying assumption that historical patterns of correlation between different markets would hold during a genuine systemic crisis, when, in fact, crises are frequently defined precisely by the breakdown of normal correlations, as panic causes investors to behave in ways that historical data, collected during calmer periods, simply does not capture. The episode also illustrated the dangers of excessive leverage, even when applied by sophisticated actors with seemingly low-risk individual trades. A portfolio of trades that are each individually low risk can still produce catastrophic losses if they are leveraged heavily enough, and if a sufficiently extreme, correlated shock occurs across the entire portfolio simultaneously. The mathematics of leverage means that even a relatively modest adverse price movement, when applied to a position leveraged 200 to 1, can wipe out the entire underlying capital base. Finally, the episode demonstrated what economists and regulators came to call systemic risk arising from interconnectedness. The recognition that a single financial institution's failure could threaten the stability of the broader financial system, not because the institution itself was systemically important in terms of its size relative to the overall economy, but because of the dense web of counterparty relationships connecting it to other major institutions. This concept, first crystallized clearly through the LTCM episode, became central to regulatory debates and reforms in the aftermath of the much larger crisis a decade later. even though many of the specific reforms that might have prevented the 2008 crisis were not implemented in the intervening years. Myron Scholes and Robert Merton had received the Nobel Prize in Economic Sciences in 1997, the year before LTCM's collapse, for work that had provided foundational tools for pricing financial derivatives, tools that LTCM itself relied upon extensively in constructing its trading strategies. The juxtaposition of Nobel-winning theoretical brilliance and catastrophic practical failure within the same firm and within the same year became one of the most frequently cited cautionary tales in the history of financial risk management. The lesson was not that the mathematics was wrong. It was that markets are not, and have never been, fully captured by any mathematical model. That the assumption of predictable, historically consistent behavior breaks down precisely at the moments when the stakes of getting it wrong are highest.